Everyone, we'll move on to the next item in risk management is capital adequacy requirements of trading members. The title itself, we can understand what is meant by what is the concept which is going to elaborated or explained in this slide. Capital adequacy requirements of trading members. So who are all the trading members? Trading members can be classified into four. Already we have discussed in the unit number 2. Professional clearing member, I think a trading cum clearing member, and individual clearing member or self clearing member, and only they are a client. So it's a different types. The very idea of this particular statement, or maybe a section which is introduced in Act of Stock Exchanges, is to avoid the credit risk. Credit risk is inevitable in financial market. What is mean by credit risk? கொடுத்த பணம் திரும்ப வருமா வராதா அப்படின்னு சொன்னோம்னா அதுக்கு பேரு credit risk. So it is inevitable in financial market. So you want to be manage them. It's a crucial part of the market functioning. So because of this reason, investments are not going to be stopped by clients or brokers or companies and so on. It is necessary. We have to go with the investments along with all that risk. How it is going to be reduced, or how it is going to be controlled, how it is going to be divided. These are the way choosing there the best option to avoid such a kind of the credit risk is called capital. One among the what we called various steps are taken by stock exchanges and the SEBI to avoid such a risk. So among them, one is there the capital adequacy requirements of trading members. How it is going to be controlled. So each trading member have an obligation to honor its commitment. I think it is related with the net worth of the company, which means the company or the broker or the investor or the whomever the person is going to be make the trade in the market, or they are going to be have the enough amount of capital to execute their orders. This capital adequacy requirement is the very idea of it is available in I think it is executed in all the equities derivative markets, and it's one of the what we call the two critical components of credit risk management, and the other being the daily margins. So one is the capital adequacy minimum, and second one is the maintain the daily margins. So how it is going to be executed, or how it is going to be implemented in the stock market is two way. One is base minimum capital. What is base minimum capital? It is the deposit which is the stock broker has to make with the stock exchanges to get trading rights on the particular stock exchange. அப்போ ஒரு புரோக்கர் அப்படிங்கிற ஒரு லைசன்ஸ் ஸ்டாக் எக்ஸ்சேஞ்சில் வாங்குறதுக்கு முன்னால அந்த ஸ்டாக் எக்ஸ்சேஞ்ச் என்ன நாம்ஸ் சொல்லுதோ, எவ்வளோ அமௌண்ட் வந்து டெபாசிட்டாக கட்ட சொல்றாங்களோ அந்த அமௌண்ட்டை கட்டி அவர் அந்த லைசன்ஸ் எடுத்தாருன்னா that capital is cost there the base minimum capital. This base minimum capital is a mandatory. It is depend upon the statutory limit of the particular broker, and to be a level of the particular broker will decided that how much money or he or she or the company has to be going to be there or invested. But even then that the base minimum capital is paid off, they will not permitted to do the trading on up to that particular level, but it is not level, it is restricted with here the some what we call a pre-specified multiple of this deposit amount. Previously it was 5 lakh rupees and 3.5 lakh rupees. It is depend upon the stock exchanges where the people are going to be registered. But over and above, after 2000, over and above the year, and in 2012 the new limit was introduced by SEBI, and it was enacted from March 2013 onwards. Then the rate is get changed. The base minimum capital deposit requirement is applicable to all stock brokers, trading members of stock exchanges having nationwide trading terminal. So the point is to be here. And after 2012, the screen-based trading was introduced due to the reason Whenever you are going to be registered yourself, you will become the nationwide broker or the sub-broker or a client. So because of the reason that the limit is also, the base minimum capital limit is also increased. It is start with the 10 lakh rupees and end with the 50 lakh rupees. It's depend upon the position taken by the broker. It is depend upon the category that the broker has enrolled themselves in the particular stock exchange. And we will move on to the next one, additional base capital. So the name, again, the name itself we will understand. So in supporting the base minimum capital, the additional base capital limit is introduced. So it is an additional benefit or additional support to the investor as well as they are the buyer or seller of the particular instrument. What is the condition? It is same, but the only condition in apart from base minimum capital, uh, based on the positions taken by stock brokers, that amount has to be additionally paid by them to stock exchanges. It is based on netting of entire trading and all, but over and above, this additional base capital along with the base minimum capital should not more than 8% of the net contract or the positions taken by particular broker. அதாவது இந்த மொத்த கேபிட்டல்ல அவர் எவ்வளவு பண்ணும், ஒரு 100 ரூபா வந்து அவர் மொத்தமா வந்து இப்ப ட்ரேட் பண்ணிருக்கிறாரு அப்படின்னு சொன்னீங்கன்னா, அந்த 100 ரூபாயில கம்பல்சரியா அவர் 8 ரூபா என்ன பண்ணிருக்கணும், ஸ்டாக் எக்ஸ்சேஞ்சில் மினிமம் கேபிட்டலா என்ன பண்ணிருக்கணும், முதலையே ரெஜிஸ்டர் பண்ணிருக்கணும் அல்லது முதலையே டெபாசிட் பண்ணி வச்சிருக்கணும். இட்ஸ் அமௌண்ட், a simple amount. It is that yes, that the broker has the what you called a position to clear all his dues. இதுல எங்க பிரச்சனை வருது அப்படின்னு சொல்லி சொன்னோம்னா, it's very idea that mean there are lot of tradings are happening, no doubt about it, but the tradings are happening if these conditions are not prevail. Why this condition is came into effect? It is because of the past experience. In sometimes back the people are making the trading but they are not honoring the contract. When they are not honoring the contract, the stock exchange or the particular uh, person may not have any control over on their that not honoring the contract some or what. So whereas this is make compulsory that either the trader has to take a delivery or else he had to surrender the a minimum amount with the thing for canceling the particular order. So it will give the two benefit to the seller. That means yes, first one assurance of selling, and second one assurance of receiving money. If both are not happening, I will get some kind of the compensation because of not honoring their particular order. So integrity against that trading is more happening and more increased in the stock broker and stock exchanges activity. So this is the reason why this base minimum capital concept was introduced. Though the what we called the SEBI is in 2012, it's introducing that the minimum capital should be 10 lakh rupees to 50 lakh according to the category, according to the level. But normally in practically this amount is not to be a prefixed one. It can be improvised, it can be increased based on the interest of the particular market. That means NSE or BSE. So NSEs are always it will be upper limit by means more than 50 lakh rupees. That means a broker is coming to register in Nifty or the NSE means they will not go with 50. It is minimum is 75 lakh and the maximum it's going to 1.25 crore rupees should be maintained as the deposit against the particular broker account. So what the point is there, exchanges are free to stipulate a higher base capital of their exchanges. So ultimately this is also a mechanism or maybe a confidence booster provided by SEBI towards the investor. If you are coming to the market, definitely your order has going to be honored, or else you will get there the enough amount of money as compensation for not honoring the order. So thank you.